Guys, if you don't know how to trade, if you don't have the money to trade, if you don't have at least $10,000 to put on a trading platform to trade, don't trade. If you're not a professional, don't trade. But if you have $10,000, you can give it to me and I will trade it for you. I bet that we will be in profit. At least I will. Then let's say something about those limit orders and market orders. The platforms where you trade, they, let's say, prefer that you use limit orders. And they don't like you to use market orders. Why? Let's imagine that everybody on the planet who is using this platform is using limit orders. What this means? It means that the platform knows exactly for each of the traders on which levels, at which prices, some traders and how much of the traders are willing to sell and how much bitcoins are they willing to sell. So if let's say there are no market orders, only limit orders, it means that the platform knows that there are in total 3 bitcoins that someone wants to sell at 100k. There are 5 bitcoins that someone wants to sell at 9, because people are putting those orders. When they're making an order, they're saying, I want to sell it at 9,000. I want to sell one, and there are 5 of us that want to say 1 bitcoin. There are total 5 bitcoins that someone wants to sell, some group wants to sell at 90,000. But also you have the other way around. There are, I don't know, 10 bitcoins that people want to buy at 50,000. There are 60 bitcoins that someone wants to buy at 30,000 price of per bitcoin. There are 1,176 bitcoins that someone wants to buy at 15,000, and so on and so forth. And this is called an order book. An order book is basically a view where you can see all the placed limit orders. You know at which price, how many of those assets, let's say bitcoins, some group wants to sell or buy bitcoin. But it's cumulative, so it's not per one trader. So all the traders that want to sell at 100k, there are in total, there are 3 bitcoins to be sold at that price. So this is the order book. And what this order book tells you, it tells you where are the basically so-called the key market levels. The key market levels are the levels from which the price tends to bounce. So let's say, like here, because you can see here, this is a level when the price bounced once, when it bounced twice. And this is the level, because on this level you have a clash of the guys who wants to sell and the guys that want to buy. And when the price reaches this point, it depends who will prevail in this order book. In this situation particularly, there were a higher pressure from the sellers, and that's why the price was rejected from this key market level. If for some reason the buyers, there were much more buyers that were willing to buy Bitcoin at a certain price, then this price would break out from this level and go above it. And then it will return, maybe it will go back and it will retest it off. Very often it goes back and in some kind of retracement and retest this level, and then it can go up and continue. And basically the big boys and the big traders, they understand this, and they see your trades, and that's why when you're putting your limit trades, limit orders, and when you are using a lot of leverage, they simply know that at this point you will be liquidated, you will be kicked out, and the money will be put back into the market. And that's why, and they will use that money to go into a long trade. That's why they are manipulating. Big guys can manipulate the markets. How? Because they can bring the price all the way down because of they can sell it. They can create they can create a huge selling pressure. They can put and push the price down. They can kick you out. They can get you liquidated, and then they can go in a reverse, and they can suddenly start buying with a huge pressure and bring the price all the way up. It's called to grab the liquidity. That's why when you're looking at the order book, you exactly know where are those pockets, where are those levels where you have to bring the price down or bring the price up in order to liquidate the people, basically to trigger their stop losses, or to automatically trigger stop losses if they are completely liquidated with no more margin. So there is zero of their dollars left in the order. So now you know what is an order book, what is a take profit, what is a stop loss, and so on. That's why the platform loves for you to enter the trade with a limit order. So the platform knows, because in 99.9% the limit orders will not be executed immediately. It will be executed at a future time when the price will reach that level. And all of the people who are looking at the order, so you're giving the money into this order book, you're putting money into the markets, and that's why you're called market maker. The people who are putting the limit orders, those are market makers. And in most of the occasions, the platform itself is rewarding those people by giving them some kind of fees, some kind of incentives, small incentives in dollars to make these kinds of orders. And for the market takers, those are the guys who are making the market orders. They are simply pulling the price from this order book. So they are not visible in the order book because they are not trading in the future. They are trading right now. And the people that are looking at the orders, the limit orders, they don't know when you will go inside and make an instant trade. That's why you have, in most of the cases, you are penalized. You are a market taker. You take the liquidity from the order book and you are penalized in a sense, in a sort of, say, some kind of a fee that you have to pay on top of your profits or losses to the platform itself, because you have taken the liquidity. And that's why if you're using the market orders and you place a market order, you will immediately see on your active orders that you are immediately in a loss. You will, let's say you're putting an order of $100, you will be immediately in loss $0.8 immediately. Why? Because you have taken the liquidity and you have been penalized. And after that, if the price will continue to go, let's say up, if you're longing, then the price can, then your profit can go to 0, can go to positive 10, and so on and so forth. So you can be positive, of course. But you have to understand, and you will see when you enter a market, if you're entering the market orders all the time, so you're opening, closing, opening, closing, opening, closing, and the price of the asset is not moving, you will lose money in your account because those fees will add up. Let's say each time $1 and you have $100 in your account, you can open 100 market orders and that's it. You will lose all of your money. And you didn't even trade and the price didn't even change. So that's why you have to understand there are fees to be paid. That is better to open a limit order, to sell with limit order, than with a market order. But sometimes when the price is very fluctuating, it's a good moment, it's a good time, then sometimes you need to go into a market order. It also goes other way around. If the price goes all the way up to here and you are in a long trade and you are in a very big profit, you are $10,000s in a profit, then you will maybe exit with a market order. You will close it immediately, close your order immediately, and then you will have to pay some kind of a fee because you are also taking the liquidity. So when you are closing your active orders, you can close it immediately at this price with a market order, or you can close it when price reaches some certain level, like take profit. Then you will not be penalized. As I said before, there is a lot of technical analysis and books that are written about how to trade simply by looking at the charts, the history, the patterns, and so on. Those are called trading patterns, and I will not go into them. I'm not a professional trader, but I have shown you last time few examples. It's let's say like this. You have different kinds of patterns, like say like a wedge pattern. So you have a price that goes up and it bounces off of these two imaginary lines. It's called a support and resistance line. And if it goes like this, in most of the cases, it will break up like this. So if you detect a pattern like this on the graph, then in, let's say, 70% of the time, the price tends to break out to the upside. If it goes like this, the price, then it maybe have this tendency to go to the downside. So it's a wedge, it's called a wedge pattern. Then you have a double bottom pattern like W, or you have a double top pattern of a price, and so on. You have a cup and a handle, so you have this kind of price movements and patterns. And people who are looking at those charts all day long, they are very familiar with those kinds of specific structures, and they are looking for these specific structures in a graph. Maybe I can show you a few examples. This is the example of a Bitcoin, and now if I draw a line, maybe you have seen this before, you can draw a line like this and you say, okay, the price is bouncing from this level, and you can make another drawing. Let me just go here, like, I don't know, like this, and you can see it's not perfect, but you can see obviously that the price is going up, down, and it somehow bounces from these two levels, and it's basically this kind of a pattern, maybe a wedge pattern, where you have a price that's going from the downside, it goes into this funnel, it jumps around, and then it finally breaks out. And as many times as this reaches and it touches this line, the line becomes, let's say, more vulnerable, and it has a higher probability that the price will push beyond, above or below of these two imaginary lines. So you have now seen an example of these graphs of how can the things be traded, what are the orders. Also, what you can use if you want to use trading view like I'm using, there are different kinds of indicators that you can use. I'm not going now into those, but you can see here there are indicators, and you can see, let's say, like volume. So this is one of the most, let's say, standard and the most used indicators. So you now here on the bottom, you can see the trading volume. So how much Bitcoin was traded at a given moment. So you now can see here why this price here was going down, because on this graph below, you can see there is a high pressure, a very big red bar in volume, saying there is a lot of people that have sold their Bitcoins, and that's why the price went down. When there was a high pressure, so every time you have a big red candle, you have a big pressure of sellers, and that's why the price at this particular moment went down. Also here, when you have a high pressure of buyers, that's why the price went up. And then people are using different kinds of indicators like RSI, so you can turn on a different indicator like RSI, like relative strength index. When you're looking at that, this index is basically telling you whether or not current asset or let's say Bitcoin current price is, and current asset is oversold or overbought. In this case, if this yellow line is in the middle, then it's neither oversold or overbought, but now it's under this middle line, so it says that the current asset Bitcoin is oversold. So there were a lot of pressure selling this Bitcoin, and then it is higher probability, doesn't mean anything, but it's higher probability that maybe there will be some more tiny bit selling pressure to the downside, and then it will be oversold if it gets out of this purple channel, then it will to the downside, then you will say it's oversold and that it's more likely to reverse and that it will go up. So the buyers will kick in and start buying. So those are indexes. You can put different kinds of settings and properties on those indicators, and you can use them to trade. If you're using only graphs, only support, resistance lines, key market levels, volumes, and different kinds of indicators to trade, then it's called a technical analysis. That's what's called a technical analysis. But you have to incorporate and include also the information about what's going on with the Bitcoin, what's going on with the rate cuts of the Fed. Is Fed buying assets? Is Fed printing money? And so on. Is the inflation up or down? What's the unemployment rate? So all of those things are basically influencing and impacting how the price will go up and down. By only using indicators and drawing these lines, it means nothing but statistics. So you are guessing what the price will be in the future by just watching the movements and historical movements and patterns of these assets, saying, okay, if it goes down like this in 95% that we have seen this pattern in previous life, in history of this asset, then the price will go 95%, it will go up or it will go down. But I don't know why it's going up currently or why it's going down. I'm just seeing the prices, I'm just seeing the red candles and the green candles and nothing more, and some kind of patterns and structures that I'm finding in this graph. But obviously the price itself is moderated by the supply demand, and this supply and demand is somehow orchestrated by the events that's all around us in the economics, in the politics. Because I know the war breaks out, the people are afraid and they're starting to selling their Bitcoins. Simple as that. Okay, I have said what is the futures trading, what is the spot trading. One of the things that you can also do on those platforms, it's called copy tradings. What it means that you have professional traders that are on that platform that are trading different kinds of assets like Bitcoin, or Ethereum or Solana, or I don't know. When we are talking about crypto, we can also have copy trading on stocks, on company stocks or ETFs. And basically, what are you doing? You are not placing orders by yourself manually. Rather, you are copying, the platform is automatically copying the orders in your name like someone else is doing. So you have one person that's a trader who is putting I don't know, 1, 2, 3 orders, one for Bitcoin going up, one for Ethereum going down, and one for S&P 500 going up. I don't know why. And what it means, if you copy this trading, then you will open proportionally with your amount of money. And they say they are putting 20% of their of their margin, of their total investment, total deposit in Bitcoin, 40% in Ethereum, and I know 40% in S&P. That means that you will put your 20% of your invested money in Bitcoin. Maybe it's less, maybe it's more in terms of total amount of dollars, but in percentage wise it's the same, and it will copy all of these trades. And what it means that you're putting your profits and your losses in the hands of another person that's maybe a good trader, a bad trader, a professional trader. It doesn't matter. The upsides are that you don't have to do it by yourself. You are believing in some kind of professionalism, that there are professional traders that have a lot of followers, so they have a backlog history chart showing how they perform during the past several years. So you somehow believe that they are very skilled people, and there is no reason to doubt them because of their history and their skills and their proven skills. So those are the upsides, and you don't have to watch all the graphs, watch all the prices. You simply put it on copy and you leave it be. But the downsides are, first of all, you have to share the profits. So a certain percentage of your profits will go to that copy trader, let's say 5 or 10% of your profit, because you don't do anything and they are doing everything, so they are copying. That's fair if they get a cut of your profits. So that's one thing. Another thing is that if you go into some kind of big loss, you're not paying attention, they can go into some kind of a liquidation, you can get wrecked, you can lose your money. So that's why I am personally using copy trading, but I'm not putting all of my deposits into copy trading. Some of the, let's say if I have $1,000, I'm giving only $200 to the copy trading, and then I'm using $800 to buy manually and placing orders manually by myself. So I'm just putting a little bit. So I have here and there some kind of copy trader just to see. And till now, thank God, I have, I believe, 4 or 5 copy traders that I'm following on 2 different platforms. And for now, I'm, let's say, in average 20 to 30% in a profit with my investments on copy trading. And for you other people who are not so keen to trading and you are not a professional and you're not interested in this, I was just teaching you and telling you this so that you know at least something. When you enter the trading platform and you are looking at the graph, so that you're not looking as a completely, let's say, dummy, that you understand at least something, how to read the charts, how to place an order, how to close an order. But you are not professional in any regards. For others, if they don't want to do this and check this and learn this and be a professional trader, what I suggest, if they want to buy Bitcoin or something like that, if you just want to buy Bitcoin, then my suggestion for you is to go with spot trading without leverage. So it's spot times 1, and you're buying the real underlying assets. So you're buying the real Bitcoin themselves. So you're using spot trading. Don't use futures trading, don't use leverage, don't do anything like that. Also, what I'm proposing to you what I also doing by myself. It's something that's called dollar cost averaging. So the people want to know, but I don't know when is the price will be at its lowest to buy and when it will be at its highest to sell. When you say buy low and sell high, it's easy to say, but I don't know when this moment will occur. I don't know if today's price is the maximum price. I don't know that. Maybe it will go up, maybe it will go down. If you don't want to trade like this, if you don't want to bother yourself with this, what you can do is you can place orders, let's say, recurringly. So you can make a recurring order, say on the 5th of each month, you will buy $100 worth of Bitcoin, whatever the price it is at that moment, and you don't care. At the end of the day, what this dollar cost averaging will do for you, it will smoothen all of the volatility that goes up and down. It will smooth this, so you will enter the market in some kind of average price. Let's say, let me draw this, so maybe you will understand it better. If you buy every month $100 on particular day, then you will buy it here, 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 you will buy it here. Understand? So you will buy it at all the prices, and when you average it up, your average price will be like this. So all of these movements from here to here, those effects are not visible, they are not taken into concern, and you are just entering with this price. It's like you bought all of those Bitcoins at this price at once. And when you are trying to sell, it's the same thing. It goes also the other way around. So you're looking at the Bitcoin chart like this. You buy it every month. You buy it and forget it. And then maybe after, I don't know, 10 years, maybe Bitcoin will be here, somewhere here. And then you will say, okay, this movement is a movement that is very important for me, that has some sense for me, and now I will start selling because I entered this and I bought Bitcoin at the average price here. Now it's here, I can sell all my Bitcoins, or you can dollar cost average while you're selling. So then it means that you will sell some Bitcoin here, sell some Bitcoin here and here and here, and you will get an average selling price because you cannot grab the peak of the markets and sell it all of your Bitcoins there. You don't know when it is. So that's why you sell 10% this month, 10% another month, etc., because you only are interested in this gap, from this average, You are only interested in this, and it's good enough for you. And in the long run, if you believe in Bitcoin, in this asset, that it will perform, it has the future, it is the future of payments, of digital currency, and so on, then it makes sense to do this kind for everyone else who wants to buy and have Bitcoin, but don't want to trade. Then you can simply do this. Buy it every month with a fixed amount of money. And then when you want to sell, also you can sell portions of your Bitcoins each month for, I don't know, each month $100 of Bitcoins you are selling. And that's it. Also, there are different types of trading that you can do. You can do day trading, you can do swing trading, you can do hodling. So what's the difference? For the day traders, those are people who are entering and exiting the trade in the same day. So they are interested in this kind of movements. They are not interested in 1 year, what will happen in 1 year. They are interested in what the markets will do today. So that's why they are looking, maybe this is, let's say this is 1 day. They enter and they exit the trade in the same day. and they are trading basically on these smaller movements. And you have to be on a, let's say, 10 minutes or 15 minutes chart on these candles, green and red. I can show you here. If I go here, if you are a day trader, then you will switch from 4 hours to, let's say, 5 minutes chart, and you will trade on this type of chart because you are interested in the price. You can see here below the current the time. It is measured in hours, so this is 3 o'clock, 15 hours, 18 hours, and so on. If I change the resolution, if I go to 4 hours, then on the bottom you will see that this time is measured in days, not in hours. So it depends on which level you want to trade and which structure you want to trade. The swing traders are some traders that open and close their trades in, let's say, week to 1 month. So this is the swing trade. So you go up and you go down. This is measured in maybe months. And this is a day trade is a trade when you trade only enter and exiting the trade in 1 day, and you're interested in prices going up or down on the level of 1 day, on a single day. Okay. Also, one thing for you to mention, to know, it's hedging. Hedge. What it means is this is a strategy that's used. It is used to protect you from potential losses by taking opposite trades and positions in a related asset. It's like buying insurance for your investment. If one of the trade is losing your value, the other one is helping you to offset the loss that you have from the first order, from the first trade. So it reduces the risk. And some of the platforms gives you the possibility to, let's say, long and short Bitcoin at the same time. Maybe it doesn't make sense, but you can, at the same price, when the price is here, you can bet at the same time that the price will go up and down. And what it means, they will, so your, let's say, your profit is 0 because how much price is going up, the other order is going down. So you have the same amount of profit and the same amount of loss at the same time, if you're using the same leverage, of course, and the same amount of money you're going into. So you're putting $100 into this trade and $100 into this trade. Then how much it goes up, the profit is the same as your loss. So you're basically at 0 all the time, but you're using, maybe you have some kind of fees, but at some certain point of time you can use this because you don't know, you're not sure if the price will go up or down, but when you see that price will continue, then you can close this trade because it plays out, one of the orders it will play out. Also, what people do, they are using futures and they are using spots at the same time as leverage. What does it mean? You are buying Bitcoin as spot. So you are buying Bitcoin at certain price and you are betting for futures, you are betting, you are shorting Bitcoin. So you are saying that the Bitcoin will go down in price in, let's say, next week. And you place this order and let's say Bitcoin starts to go down, the price starts to go down. It means that you will get your profits from this order because you said it will go down, you shorted and it went down, and then you make a profit. And you have this spot that, let's say, as your hedging, because this made you money, this made your profit, but you lose money on your spot trading because the value of your Bitcoin went down. But also it has a reversal effect. If you say that the price will go down, but the price suddenly starts to go up, then you are in loss with this order you have made a bad decision. You said you shorted the Bitcoin, but it went up. But you have some kind of a loss on this trade. But nevertheless, because Bitcoin went up, your portfolio of Bitcoin, the value of it went up, and it somehow decreased the effect of loss of your shorts, because you gain, I don't know, $5,000 you gain on this spot trading, but you lose, I don't know, you lose or you lost $2,000 on this trade, and you are $3,000 in profit. Of course, if you didn't put this trade, you would be $5,000 in profit. But nevertheless, let's say that this futures order played out, you have gained $5,000 from this trade, and then it reversed, you exit the trade, this also gain you 5,000, then you will be 10,000 in dollars in profit. So it depends. So what are some of the good practice? One of the good practice is, if you have a deposit, you have put on your platform $10,000, let's say $10,000. Maybe you don't have the $10,000. If you don't have $10,000, then you don't trade on such kind of platforms. Trading with $100 is simply stupid. You can buy Bitcoin, it's okay, but don't trade like futures or something like that. It doesn't make any kind of sense. If you have a deposit of $10,000 in the platforms, for each trade, you shouldn't use more than 1 to 2%. So don't be a degen, don't be a lunatic, don't put $10,000, all $10,000 in one trade. It doesn't make any kind of sense. Put 1%, okay? So put $100 in one order. $100 to $200 in one order, in one trade. That's one thing. Second thing, if you put an order and you have a loss, then you put an order, next order, second and the third order, and it doesn't play out as you wish. If you have 3 strikes, 3 losses, 3 strikes, you're out. Stop trading for this day and don't try to regain all of your lost money, because you're in an emotional state that you're not thinking straight, you are angry, you want to make regain all of your money quickly, and in most of cases, if you continue and make another order, in most of the cases you will just lose even more money. So if you have 3 strikes, you're out. Don't trade for this day, go to sleep, trade the next day. Also, a good practice is to track all of your trades. So you know, why did you place a long or short order? Why did you put a take profit or stop loss order, and write it down in some kind of Excel spreadsheet or something like that? And then say, I bought this amount of Bitcoin at this price. I put a take profit here. I put a stop loss here for these reasons. I went into long trade because I have heard that the Fed had some kind of a rate cuts or something like that at this moment, and I have seen that BlackRock started to buying Bitcoin like they were insane. So that's why the reason, so you have a definition, you know why did you, or there is a pattern somehow that is just another additional thing on top of everything, saying, okay, this is a pattern. This is a falling wedge pattern, and it broke out. The news are good, the economics are good, the politics, the macroeconomics are all good. That's why I have entered this trade as a long. So I said that the price will go up, and I put take profit, let's say here, and I put stop loss here in 3 to 1, and then you just write down the outcome. Did you make a loss or did you make a profit on that order? Then you will know on the long run, why did you enter the trade, which indicators, maybe the RSI, the volumes, etc. So that you know historically what is your trading style, and that you know what fits you and what plays out for you the best, so that you know in the future that 80% of the time, if you are trading like this, you are 80% of the time you are right. So you will gain profits. There is no such things at 100 times that you are right, and 100 of your orders will be closed with a profit. There is no such thing. So just if it's 40% of orders that are played, you are in profit, it's very good. Then you will say, how it's good? Because you are 60% in a loss. Yes, it's correct. That's why you have a take profit and stop loss 3-1. You understand me? If you are gaining profits on this, it's 3 times more. So it's 120 than this, so it's 60. So you understand, it's an asymmetric thing. So when you are taking profits, you are taking big profits, and when you are taking your losses, you are taking small losses. So keep your losses small and your profits big, and at the end of the day, this plus that minus that equals you are in profits, even though you are only 40% of the time correct. And that's it, guys. I hope that you enjoyed. I didn't. In this, and that you now at least know how trading is done, what is the technical analysis, what are these terms that are used while you are trading, the long, the shorts, the futures, the hedging, day trading, swing trading, and so on. You have learned the graph, you have learned the market, the money, and so on. You now have the right mindset, and the next time we are going to open a Bybit, or let's say a Bybit account for trading crypto, and then we'll put some money and we'll start to trade, and you will see how it goes. But at least then you will know, why did I press the buy button, why did I put the stop loss there or take profit there. You will at least then understand and see with your own eyes what is going on the platform. Of course, we are going to trade Bitcoin. You don't know, let's say you don't know anything about Bitcoin, you don't know what it is, what is blockchain, and so on. We'll have a different podcast about that, just for you to learn about Bitcoins, about cryptos, and so on. But for now, we are going to just show how to use the platform, how to trade. It's easier for me to trade with crypto because I understand it, but we can trade with S&P, we can 500, we can trade with ETF, we can trade with stocks, it doesn't matter. The technicals, it's the same. So it's always the orders, market orders, limit orders, futures, this and that. So it is always the same. The only difference is what is the asset underneath. Is it Bitcoin? Is it something else? And then afterward, we are going to deep dive into the blockchain and Bitcoin and other altcoins, just for you to know what is all about. But then we are going to move away from the trading and so on. So you can then try it by yourself. Also, big thing to say is that on the platform that we are going to use, that I'm going to show you, you have it already in my link in the headers of the YouTube channel. So it's Bybit account. You have my link, a Bybit platform. You have my link in the YouTube headers, in the link sections, and you can use it to get initial $6,000 of deposit bonuses if you're using my personal link. If you're going to copy what I'm doing and registering yourself on that platform, then please don't go directly on Bybit. You will go with my link. It will redirect you to the Bybit, and you will get additional bonuses while you're registering. So it's free money. I would take it on your place. So why not? Just take it and have fun with that free money. So guys, that's it. Please, as always, share, like, subscribe, write in the comments what you think. Am I right? Am I wrong? What do you think that I have to improve? And basically, I believe that is it. See you next time when we are going to do a little bit of trading. Bye, guys. And guys, if you want to learn more about certain topics that we are covering in this podcast, like how to do affiliate marketing, how to do trading, crypto, forex, finance, general finance, and you want to learn more about how to escape the ordinary, how to escape this matrix pit and know the information that I am personally learning, then you have a possibility to enroll and to find out more in this game changer application. So the application is also available through the link that is available on my personal page. So you have a link here in the descriptions that you can go and check by yourself.